Tonight the futures markets close, tomorrow they close again. And Sunday evening, when Asian markets reopen, the gold price will be wherever it is, with no trading in between to get there. No intermediate price discovery, no gradual move, just a gap, straight to the new number. And right now, heading into this specific weekend, the list of things that could move that number by Monday morning is longer than I have seen it in a very long time. Gold is at 5,182, silver is at approximately 86 yuan. The US-Iran war is active with no ceasefire confirmed. Oil touched near $120 earlier this week before partially reversing. The Federal Reserve meets in 6 days on March 18th, and COMEX registered silver is sitting at a coverage ratio of 13.6%. A number I am going to explain in detail because it changes how you think about everything else. This video is about one specific thing, what gap risk actually means mechanically, why this particular weekend is elevated risk, and what that means practically for someone sitting at home right now with a position in gold, silver, or a leveraged ETF. Last week I told you to watch the Federal Reserve March 18th meeting language specifically, not the rate decision itself, which is priced in as a hold, but the inflation language in Powell's press conference. I said, if the language shifted toward caution about the second-half rate cut timeline, that would reinforce gold's inflation hedge function at the institutional level. That meeting has not happened yet. It is 6 days away. The call is still live, and we will return to it next video with the full result. What has changed since I made that call is the macro configuration heading into this weekend has become more binary, not less, which is exactly why this video needed to happen today, on Thursday, before the window closes. I am John, FX Insider, 15 years in currency and commodity markets. In that time, I have watched gap events hit positions that people thought were safe. I have seen traders who understood the fundamentals perfectly get hurt, not because they were wrong about the direction, but because they were not positioned correctly for the gap between sessions. That is what tonight is about. Everything I show you today comes from publicly available sources, and I will name everyone as we go. 3 things we are covering. First, what a weekend liquidity gap actually is, and why most retail investors underestimate it until they have experienced one. Second, what makes this specific weekend more gap-prone than a normal weekend? And there are 5 separate factors stacking right now, not one. Third, what the realistic scenarios look like for Monday's open, and what each one means for different types of holders. Let us get into it. Gold right now is at $5,180 per ounce. Silver is sitting at approximately $86. Those are the Thursday close numbers, the last prices these metals will have in the COMEX session before the weekend begins. If you are holding either metal in any form right now, physical, ETF, mining stock, futures, options, those numbers matter to you personally. The question this video answers is whether the number you wake up to on Monday morning is going to look like that, or whether it is going to look significantly different. And here is what I want to be direct about from the start. I am not predicting a crash. I am not predicting a spike. What I am saying is that the conditions for a large Monday gap in either direction are more present this weekend than they have been in a while. And understanding why, mechanically specifically, is what gives you the ability to make a rational decision about your positioning before the window closes tonight. Quick question before we go further. Drop in the comments right now. Going into this weekend, are you holding leveraged silver or gold exposure, futures, options, leveraged ETFs, or are you purely in physical and unlevered positions? I genuinely want to know the composition of the audience right now because it shapes how I frame next week's video. Drop it below. Let me start with the mechanics, because this is the part that gets skipped over. Most people understand in theory that markets close on weekends. What they underestimate is what the closed period actually means for price. During a normal trading week, if a major headline breaks, a Fed official speaks, a conflict escalates, an economic number surprises, the price moves in real time. There is continuous price discovery. The market absorbs the information gradually as buyers and sellers respond. Positions adjust. Stops trigger incrementally. The move happens in steps. A weekend gap is completely different. Picture a dam. During the week, water flows continuously. If the river level rises, water spills over gradually. The level adjusts. Everything downstream sees a manageable flow. A weekend gap is what happens when you close the dam on Friday evening and open it again Sunday night. Whatever has built up behind it, whatever news, whatever reallocation, whatever panic or enthusiasm, comes through all at once. There is no gradual. There is no intermediate. The price opens Sunday evening in Asia at wherever the accumulated information says it should be. And if that number is $150 away from where it closed on Friday, that is where it opens. Full stop. For someone holding a leveraged position, a futures contract, a leveraged ETF, or an options position with limited buffer, that gap can trigger a margin call, a forced liquidation, or a loss that exceeds what they were prepared for before they have had a chance to react. For someone holding physical metal or an unlevered ETF, the same gap is noise. They wake up Monday morning at a different number, but they have not been forced out of their position. The structure of what you hold determines whether the gap is a problem or just a number. If you know someone who is holding leveraged precious metals exposure right now and has not thought through this weekend specifically, share this video with them before tonight. Seriously, this is time-sensitive information, and the window closes when COMEX does. Now here is why this specific weekend is different from a normal weekend. There are 5 factors stacking simultaneously right now, and I want to walk through each one because they are not equal in weight, and you deserve to know which ones I am most focused on. The first factor is the Iran situation. The US-Iran conflict is active. No ceasefire has been confirmed. Iran's Revolutionary Guards have dismissed ceasefire talk publicly. The Trump administration has sent conflicting signals, some messaging suggesting the conflict could resolve, other senior officials indicating operations are intensifying. That kind of conflicting signal environment is exactly what produces binary weekend outcomes. A ceasefire announcement breaks Saturday. Gold gaps down $150 to $200. A major escalation or strike on a key oil facility breaks Sunday. Gold gaps up $100 to $150. Both are live scenarios. Neither is a tail risk this weekend. The second factor is oil's current volatility. When I look at what oil did earlier this week, touching near $120 before partially reversing, that kind of intraday range tells you the market has no settled view on the supply picture. Oil and gold are not perfectly correlated, but in a conflict-driven environment they move in the same direction under escalation and diverge on resolution. An oil shock over the weekend translates directly into a Monday gold and silver move. The third factor is the Federal Reserve meeting on March 18th, which is 6 days away. Markets do not like holding large positions into a Fed meeting, especially when the inflation picture is unsettled. The February CPI came in at 2.4% year over year, according to the Bureau of Labor Statistics, matching expectations. But here is what that number does not contain: the energy price impact of the Iran conflict. That data was collected before oil spiked. March and April CPI readings are where the shock shows up. Institutional participants know this, and some of them will reduce position size before a weekend that sits between a volatile geopolitical situation and a Fed meeting, which means the market heading into the close today may already be thinner than normal. Thinner liquidity on the way into the close means any Sunday gap has less cushion. The fourth factor is where this analysis gets specific in a way I want to spend time on. COMEX registered silver is currently sitting at a coverage ratio of 13.6%. Here's what that number means. When a silver futures contract reaches expiry, the holder has the option to demand physical delivery of real metal. COMEX is obligated to deliver. The registered inventory is the pool of metal that is certified and available for that delivery right now. A 13.6% coverage ratio means that if a significant percentage of open interest holders decided to stand for delivery, to actually take the metal, the registered pool is not deep enough to cover it without stress. Now, the important context, and I want to be honest about this because it is a number that gets sensationalized, is that COMEX has mechanisms. Eligible inventory can be converted to registered. Emergency arrangements exist. A hard default is not the base case. What the 13.6% figure tells you is something more precise and more actionable. Institutional participants approaching the May delivery window are already running models on whether sufficient metal will exist. That calculus changes with every weekend. Think of it like a restaurant that has bookings for Saturday night, but only has ingredients confirmed for 13% of the tables. The restaurant does not necessarily close, but the kitchen is having a very different conversation than a restaurant with a full larder. And when that kitchen sits down to plan over a weekend, where 3 separate suppliers might or might not show up, the uncertainty compounds. For silver specifically, that 13.6% coverage ratio means this weekend's gap risk is amplified on the upside if any delivery pressure signal emerges from the conflict or the macro data. The fifth factor is the Shanghai premiums. When I pulled up the current SGE data this week, gold is trading at approximately $5 to $15 above COMEX in USD terms. Silver is showing a $3 to $5 premium on the SGE over COMEX. These are not anomalies. They have been persistent across multiple sessions. What that tells me is that Asian buyers, who are the first movers when Sunday trading opens, are already paying above Western paper prices for physical metal. That means when Asian markets open Sunday evening, they are not opening from a neutral stance. They are opening from a position of active physical demand. If a conflict headline breaks over the weekend, that demand does not evaporate. It intensifies. And the gap on Monday morning reflects where Asian buyers push the price before New York even wakes up. All right, let me show you how I am thinking about this weekend, specifically using the 3 lanes framework. This is how I separate what is noise from what actually matters. The paper lane, blue. COMEX open interest in both gold and silver remains elevated, according to the most recent CFTC commitment of traders data. Speculative long positioning is present. What that means for gap risk specifically is that when gaps occur in a market with elevated open interest, the forced liquidations on the wrong side of the gap amplify the move. More open interest means more potential energy in a gap scenario, in either direction. The physical lane, silver-colored. COMEX registered silver at 13.6% coverage. SGE silver premium at $3 to $5. SGE gold premium at $5 to $15. The physical market is not relaxed heading into this weekend. The signals are tight. The macro lane, gold. DXY at 99.1 to 99.4. 10-year yield at 4.15%. February CPI at 2.4% with March and April readings incoming. Fed on hold March 18th but language uncertain. Iran conflict unresolved. Oil volatile. In 15 years watching currency and commodity markets, I have seen gap events that surprised everyone, including people who were watching all the right indicators. What I have learned is that the gap itself is rarely the surprise. The surprise is always the size. When multiple factors stack, elevated open interest, thin coverage ratios, active conflict, a major central bank meeting 6 days away, the gap does not just happen. It overshoots. It goes further than the information alone would justify because the forced selling or forced buying on the wrong side of the gap adds fuel to a move that was already in motion. That is what I am watching for this weekend, not just a gap. An overshoot in either direction. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this weekend. One thing. Any official statement from the Iranian government or the U.S. administration on the conflict status between now and Sunday evening New York time. Not a rumor. Not a social media post. An official government statement. Here is why that specific signal matters above all the others. Every other factor I described, the coverage ratio, the SGE premiums, the Fed meeting, those are slow-moving structural conditions. They do not resolve over a weekend. The Iran situation can. A credible official ceasefire statement is the single event that could produce a $150 to $200 gold gap down and a $10 to $15 silver gap down on Monday morning. A confirmed escalation, particularly anything involving oil infrastructure, produces the mirror image in the opposite direction. I am not watching Twitter. I am not watching news aggregators. I am watching for official government communications from both sides. That is the binary event that determines Monday morning. This is my one call for the weekend. John, FX Insider, on record. I will be back Monday or early next week to tell you exactly what happened and what it meant for the positions we have been tracking. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is the section where the honest version of this analysis matters most. Here is what needs to happen for the optimistic picture on Monday. The weekend passes without a major headline. Mixed signals continue. Gold opens within $30 of Thursday's close. Silver opens within $2. The base case holds. Consolidation continues ahead of the Fed meeting. For people who are not leveraged and not mark-to-market sensitive, Monday morning looks like any other Monday. The structural case for both metals is intact, and nothing about the weekend changed it. Here is what needs to happen for the difficult picture on Monday. A credible ceasefire breaks over the weekend. Oil dumps. The DXY spikes above 101. Gold opens at $4,180 to $5,050. Silver opens at $78 to $80. Paper-driven liquidation accelerates because forced selling from leveraged positions that cannot withstand the gap adds to the natural selling from the ceasefire news itself. For leveraged holders who did not size their position to absorb a gap of that magnitude, the outcome is a forced exit at the worst possible price, not because their thesis was wrong, but because the gap came before they could react. And for the escalation scenario, a weekend strike on oil infrastructure, a confirmed widening of the conflict, Gold opens at $5,300 or higher. Silver opens at $92 to $94. The coverage ratio conversation becomes acute. Physical premiums widen further. Both are genuinely possible right now. The base case is more probable than either extreme. But probable and certain are not the same thing. Your job this weekend is not to predict which scenario materializes. Your job is to know which scenario your current position can survive, and which one it cannot. The market will tell you what happened. The only question is whether you were sized to hear the answer without being forced out. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers. First, are you going into this weekend with any leveraged precious metals exposure, or are you purely physical and unlevered? Tell me exactly where you are sitting right now. Second, of the 5 gap risk factors I walked through today, Iran, oil volatility, the Fed meeting, the 13.6% COMEX coverage ratio, and the Shanghai premiums, which one do you think is the most dangerous heading into Monday? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we are coming back to the Federal Reserve March 18th meeting result. I will be telling you exactly what Powell said, exactly how gold responded, and whether my call on the inflation language hit or missed. That video will be essential context for anyone positioned in either metal right now. And if someone in your life is going into this weekend with leveraged precious metals exposure and has not thought through the gap risk, share this with them right now. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.